Lithium Americas Corp is trading right now at $4.48. That's down about 2.71% on the session. Now, most investors see that price, they see that terrible one-year chart, and they dismiss this as just another failed mining speculation, completely broken by the collapse in lithium prices. They see a company that might produce lithium someday. They see the red on their screen and move on. But what the market is fundamentally miscalculating right now isn't the price of lithium. It's the geopolitical value of this specific asset. What's happening today at $4.48 isn't about lithium carbonate prices in China. It's about the market's complete failure to price in the national security premium of Thacker Pass. The common belief, the expectation, is that LAC is a simple leveraged bet on the commodity. If lithium prices go up, LAC stock goes up. If they stay in the gutter, LAC bleeds out. That's the story you'll hear everywhere. And for the last 18 months, that expectation has held true. The stock has been decimated, falling from highs of over $30 down to these levels. Investors look at this, maybe on their Robinhood app or SoFi Invest platform, and they just see red. They see it as a wait-and-see story, entirely dependent on a commodity rebound. They categorize it as speculative and move on to what feels safer, like Apple stock or a broad Fidelity mutual fund. But that's where the reality of the situation gets far more complex and, frankly, far more interesting. The reality is that LAC, post-split, is no longer just a lithium company. It is the American lithium company. It's a pure-play bet on a single asset, the Thacker Pass project in Nevada. This isn't some speculative drill hole in a remote jurisdiction. This is arguably the most significant, fully permitted lithium project in the Western Hemisphere. The market is treating it like a high-cost optionality play, but the reality, it's a strategic asset, and it's being treated as such by players far larger than the traders selling it down 2.7% today. So why is it trading at $4.48 down again today? Because the expectation that this is all about the commodity price is still driving 99% of the trading volume. The spot price for lithium carbonate is still painfully low, bouncing off the bottom. We are in a period of significant oversupply, primarily from Chinese-backed lepidolite projects and massive Australian spodumene production that came online faster than near-term EV demand absorbed it. This hammered the price, and as a result, institutional funds managing Fidelity wealth management accounts or large portfolios were forced to liquidate their lithium holdings. They can't hold underperforming assets. This selling begets more selling, and a pre-production company like LAC, which has zero revenue, gets hurt the most. It's pure sentiment trading. This stock is a pre-production developer. Its daily swings, like the one we're seeing today, are almost entirely driven by macro sentiment and ETF flows. It gets bundled in with actual producers like Albemarle or SQM, and when they sneeze, LAC catches a cold. Traders on platforms like Interactive Brokers might be shorting the entire sector basket, and LAC gets dragged down with it. This creates a massive disconnect. You can't value LAC the same way you value NVIDIA stock, which is gushing cash flow. You can't even value it like Tesla stock, which is the ultimate consumer of the lithium. This is a project finance story being incorrectly priced as a broken commodity story. The institutional activity is fascinating. On one hand, you have momentum traders and quant funds dumping the stock because it fails every screen. The chart is broken, the sector is broken. But on the other hand, you have strategic investors. The elephant in the room is General Motors. General Motors hasn't just talked about Thacker Pass, they've put $650 million on the table, the largest ever investment by an automaker into a battery raw material. The first tranche of that is already in. The second tranche is contingent on the financing for Phase 1 construction closing. GM needs this lithium to be IRA-compliant. They are not an investor looking for a 20% pop. They are a customer securing their entire EV supply chain for the next decade. Let's go deeper into that GM investment because it's central to the entire thesis. This isn't just a financial stake. This is a supply offtake agreement. GM has the right to 100% of the Phase 1 production. Why would they do this? The Inflation Reduction Act. To get the $7,500 EV tax credit, automakers must source their battery minerals from the U.S. or a free trade agreement partner. China is excluded. Thacker Pass isn't just a source, it's the largest and most advanced source in the United States. GM's investment wasn't an investment, it was securing their production pipeline. This is a level of security that you don't see in many other sectors. The $4.48 price today reflects none of this strategic premium. It's trading like a failed junior miner, not a cornerstone of the U.S. auto industry. This is where many retail investors, perhaps managing their own individual brokerage accounts or using a Fidelity platform, get shaken out. They see the daily chop, the 2.7% drop today, and they panic. They don't see the long-term, locked-in strategic imperative that GM's investment represents. They're looking at their Fidelity mobile app and seeing a loss, while the corporation is looking at its 10-year production plan and seeing survival. Trading volume on a day like today is likely average to low. This isn't a panic selling day. This is a slow bleed. This is apathy. And apathy is often the moment of maximum opportunity. The expectation is that the stock will do nothing until lithium prices recover. The reality is that the next major catalyst for LAC has nothing to do with spot prices. It has to do with the DOE loan. LAC has applied for a massive loan from the Department of Energy's Advanced Technology Vehicle Manufacturing Program. We are talking billions. This is the same program that helped Tesla scale in the early days. If that loan comes through, and indications are positive given Thacker Pass's alignment with national policy, it completely de-risks the construction financing. That is the catalyst that the $4.48 price is not factoring in. The market is waiting for lithium prices. I'm watching for a press release from the DOE. So for those who are new to this story, let's quickly clarify what Lithium Americas Corp is today. After the company split in late 2023, the old LAC was divided. The assets in Argentina, specifically the producing Cauchari-Olaroz project, were spun out into a new company, Lithium Americas Argentina, or LAC. What is left as LAC is a 100% ownership stake in Thacker Pass in Nevada. That's it. It's a pure play on a single, massive, U.S.-based asset. Thacker Pass is a clay deposit, which is different from the brine, Argentina, Chile, or spodumene, Australia operations. It requires a different extraction process, which has its own technical risks. But the scale is world-class. The goal is to produce 40,000 tons per annum of battery-grade lithium carbonate in Phase 1 and eventually double that to 80,000 tons in Phase 2. This isn't a small mine, it's a foundational piece of the entire U.S. EV supply chain. This brings us to the future outlook and the severe tension between expectation and reality. The expectation is that this is a 5 to 10-year story, that you buy it at $4.48 and just wait. Wait for EVs, wait for prices, wait for production in 2027. The reality is that the value of this stock could be repriced dramatically and much sooner on a financing announcement. The bull case is simple. The DOE loan is approved in the coming months. This greenlights the main construction financing. GM's second tranche of $330 million is unlocked. Suddenly, LAC is no longer a speculative developer. It's a fully funded construction project with its first customer, GM, locked in. In that scenario, $4.48 looks laughably cheap. The market will be forced to stop valuing it based on today's depressed lithium spot price and start valuing it based on a discounted cash flow model of a mine that is getting built, pulling in $1 billion+ in annual EBITDA at current low prices. Conversely, the bull case isn't just lithium prices go up. The bull case is that LAC becomes the premium benchmark for North American lithium. If the DOE loan is approved and construction begins on time, LAC could command a premium valuation to its peers because its jurisdiction, Nevada, is stable, its customer, GM, is locked in, and its product is IRA-compliant. What are the risks? They are not trivial. The first is execution. This is a massive chemical processing plant, not just a hole in the ground. The technical risk of clay extraction is real. Brine, Argentina, Chile, and spodumene, Australia, are well understood processes. Clay-based extraction, which Thacker Pass will use, involves roasting the clay in a kiln and then leaching it with acid. LAC has run its pilot plant successfully, but scaling that to 40,000 tons is a massive engineering feat. Any hiccup here will be punished. If they announce a 12-month delay or a $500 million cost overrun, this stock will test new lows. This isn't a stock you put in your Fidelity IRA and check in 20 years. This requires active monitoring. The second risk is legal. While the main record of decision was upheld, there are still minor ongoing legal challenges from environmental and tribal groups. A significant negative ruling could cause delays, though most analysts see this as a low probability at this point. The third and most obvious risk is the lithium price staying